Entering the world of real estate investing can be one of the most rewarding financial moves you'll ever make. But for new investors, it can also be full of pitfalls that are hard to avoid without experience. You may have heard of people who make millions from flipping houses or collecting rental properties, but those stories often leave out the mistakes that led to their success. What if I told you that knowing what not to do could be just as important as knowing what to do? In this video, we're going to break down the top 7 mistakes new real estate investors make, so you can avoid these costly errors and start building a profitable portfolio. These mistakes are all too common, and they're often the reason why many people never make it past their first investment. Whether you're looking to flip houses, buy rental properties, or even start a real estate business, this video will give you the insights to move forward with confidence. The goal is to help you make smarter decisions that will accelerate your path to success in real estate investing. So, before you make your first move, make sure you watch through to the end. This could be the most important investment advice you'll ever get. 1. Failing to do proper research. One of the biggest mistakes new real estate investors make is failing to thoroughly research the market and property before purchasing. Real estate is all about location, and if you don't understand the local market conditions, such as property values, rental rates, and neighborhood trends, you're setting yourself up for failure. Even a seemingly great deal can quickly turn into a financial nightmare if the property is in a declining area or has unforeseen issues. Successful investors spend time studying the area, talking to local agents, and checking recent sales data. Research isn't just about knowing the property, it's about knowing the entire market landscape. Skipping this step is a costly mistake that could easily be avoided. Proper research gives you the power to identify great opportunities and steer clear of poor investments. 2. Underestimating repair and renovation costs. Many new investors fall into the trap of underestimating the costs of repairs and renovations. It's easy to look at a fixer-upper and think that a fresh coat of paint and a few minor upgrades will increase the value. However, these projects can often escalate quickly in terms of both time and money. You might discover hidden issues like plumbing problems, structural damage, or electrical rewiring that weren't obvious at first. To avoid this mistake, it's crucial to get a detailed inspection before purchasing and budget for contingencies. You should also work with experienced contractors to get realistic cost estimates for renovations. Investors who fail to account for these hidden expenses often find themselves stretched thin financially and unable to complete the project. 3. Ignoring cash flow and focus on appreciation. New investors often focus too much on the potential for property value appreciation, assuming the market will always rise. However, putting all your hopes on appreciation is risky and unrealistic, especially in volatile markets or during economic downturns. Cash flow should always be your priority. A property that generates consistent rental income month after month can provide long-term financial stability, even if the property value fluctuates. Many rookie investors neglect to do the math on rental income versus expenses, leading them to overlook the importance of cash flow. If you're not paying attention to how much money you're actually making every month, appreciation alone won't save you when things go south. Always prioritize cash flow over speculative gains. 4. Not understanding financing options. Real estate financing can be complex, and not understanding your options is a big mistake that many new investors make. Whether you're using a traditional mortgage, private moneylenders, or hard money loans, it's crucial to understand the pros and cons of each option. Many investors jump into deals without fully comprehending the terms, interest rates, or the long-term financial implications of their financing. This can lead to higher than expected costs or poor returns on investment. Additionally, new investors might not know how to leverage financing creatively, like seller financing, lease options, or using equity from another property. Understanding the financial side of the deal is just as important as finding the right property. Take the time to educate yourself about different financing strategies to avoid costly mistakes down the road. 5. Overleveraging yourself. Overleveraging is a common mistake that can quickly lead to financial ruin. New investors often get excited about purchasing multiple properties and using debt to finance these acquisitions. While leverage can amplify your returns, it also increases your risk. If the market turns, or your rental property becomes vacant for an extended period, the costs of servicing that debt can quickly spiral out of control. This is especially true if you haven't built in a safety net of reserves. The key is to balance your debt with enough cash flow and reserves to weather unexpected challenges. Avoid stretching yourself too thin financially by taking on more than you can manage comfortably. If you can't afford to hold the property during a downturn, it's not a smart investment. 6. Not having a clear exit strategy. A lot of new investors jump into deals without a clear exit strategy in mind. Whether you're flipping a house or holding a rental property, it's essential to have a clear plan for how and when you'll sell or refinance. Without this foresight, you may end up stuck with a property that no longer fits into your long-term goals. For instance, many investors fail to consider the possibility that the property market could turn against them before they're able to sell. This can leave them unable to exit the deal as planned, especially if the property is underperforming. Before buying any property, make sure you have an exit strategy in place, whether it's flipping the property after a few upgrades or holding it for long-term cash flow. 7. Disregarding the importance of networking. Real estate is a relationship-driven business, and new investors often underestimate the value of networking. Networking can open doors to financing options, off-market deals, and experienced mentors. It can also connect you with reliable contractors, agents, and property managers who can make your investments run smoothly. The most successful investors are those who actively build and nurture their network over time. Whether through local real estate clubs, online forums, or industry events, connecting with others in the real estate world gives you valuable insight and opportunities. If you're not networking, you're missing out on a powerful tool that can accelerate your growth and reduce the risks of real estate investing. By avoiding these 8 mistakes, you'll be much more equipped to navigate the real estate market with confidence. Remember, success in real estate doesn't happen overnight. It's about avoiding costly mistakes, making informed decisions, and continuously learning. If you're new to real estate investing, taking the time to educate yourself and build a solid foundation will pay off in the long run. Start slow, understand the risks, and focus on building a portfolio that provides both stability and growth. Stay adaptable to market shifts and always reassess your strategies to ensure they're aligned with your goals. Networking with industry professionals and learning from others' experiences can also provide invaluable insights. Trust the process and don't rush. Patience is key in this game. If you found this video helpful, make sure to like and subscribe to the channel. We'll continue sharing expert insights to help you become a more successful investor. Stay patient, stay strategic, and stay committed to your real estate journey. Thanks for watching, and good luck.